Welcome back to our special broadcast of the MPC. In case you missed it, the Reserve Bank Governor Lesicha Kganyago announced that the bank has decided to cut interest rates by 25 basis points. That takes the repo rate to 7% and the prime rate, that is the rate at which commercial banks lend to their customers, at 10.5%. Well, to get some reaction on this, I'm now joined by Koketso Mano. She's an economist at FNB. Thank you so much, Koketso, for joining us. So the market pretty much expected that there would be a cut. The Reserve Bank governor says that this was a unanimous decision. Your thoughts?
Thanks for having me, Nompu. Yes, definitely what the market expected. That was the consensus call, that we would have that 25 basis points coming in today. I guess there was a concern that maybe if the MPC chooses to, focus on global dynamics and the volatility at that level, we might see what they did in March, which was a pause. But I guess, the weak underlying economic dynamic in South Africa has really pushed the MPC to be able to focus on local dynamics and push through that interest rate cut earlier than maybe some of us may have anticipated or feared.
Yeah, well, let's cut straight to the chase and talk about the announcement that the Reserve Bank governor made, which is that while the actual inflation target remains 3 to 6%, with a preference for 4.5%, they now prefer, that is the bank now prefers to focus or have as its anchor the bottom end of that range, that is 3%. Even though it's still in discussions with National Treasury. It all sounds quite confusing. What do you take away from what the governor had to say about that?
Nambu, this is a conversation I think we've been having for quite some time. We said that the MPC would like to shift to a lower target, likely 3%, in line with, other emerging markets, especially in Latin America, for example. And we've said that they would do that as soon as possible. Given that, inflation is weak currently, it's expected to rise in the second half of the year. So in order for them to take advantage of currently weak inflation, they would have to move very soon, make sure that they start, influencing inflation expectations. So us as agents, as we make decisions, they wanted to influence that so that we remain with this mindset of low inflation. Because once inflation starts to rise, it's harder for people to understand why they should, factor in lower price growth as they make their price decisions, as they ask for higher wages. So it made sense that the MPC would try to move as soon as possible. I guess what we're seeing in today's statement is that the MPC maybe is taking the approach that they did in 2017 when they said they preferred the midpoint of the inflation target range, which was 4.5%. And they were able to really shift towards that lower de facto target, even though de jure, you still have 3 to 6% as the target that the government or National Treasury would have set. So we're seeing that again this time. They're saying we prefer 3%. And they're still within that 3 to 6%. So operationally, they're saying we prefer to work with 3%. And I guess what is still to happen from the Treasury point of view, from the political point of view, is basically just formalizing this lower target. But I think the MPC has made its point.
And then in terms of growth, they reduced their growth outlook, saying that they expect growth for this year to come in at 0.9%, and for 2026, 1.3%. And the governor did talk about sacrificing a level of growth while we try and target lower inflation. Perhaps you can unpack those concepts for us.
Yeah, and I guess maybe the easiest part to start with is, the lower trajectory when you look at economic growth is influenced by the starting point. So we have to factor that in. The fact that we've had weak economic activity in the first half of this year has led to us, seeing lower projections for economic growth, not only for 2025, but also for 2026. We've also downgraded our forecast quite meaningfully since the start of the year when we were seeing close to 2% growth, but now we're sitting at 1%. So the economic activity data has been quite disappointing. But I guess where monetary policy really comes in here is we can anticipate that if the MPC wants to shift or is going to start preferably targeting, a 3% inflation level or inflation rate, it will have costs to the economy, even though those costs may be mainly nominal, right? So when you think about, for us, for example, we may have to experience some wage reduction in real terms when you think about inflation, we may not see growth in our salaries as high as inflation. So we're also taking a bit of the knock to make sure that inflation remains low. Businesses may take a bit of a knock when you think about the ability to pass through costs. So there will be those that sacrifice that comes in. And so when you look at the trajectory of interest rates, right, you still see around 7%, for example. That's our anticipation for the remainder of the year. So maybe monetary policy is tighter than what it would naturally be with a lower inflation target. So that means that there will be some sacrifice to economic activity in order to manage inflation or guide inflation expectations lower. And once you see that happening with lower inflation expectations, with lower actual inflation, then the MPC would be able to continue cutting interest rates and easing the restrictiveness of monetary policy on the economy. And that's why you probably see with a lower inflation target, monetary policy rates being not at 7% as they would be, for example, if you are targeting 4.5%, you might see them below 6%, closer to 5.5%. So that is the gains that they anticipate the economy to make over the years as inflation is lower, that would beget lower interest rates. But unfortunately, in the near term, you will have to see some of that cost driving or the pressure on the economy driving that inflation lower more sustainably.
Yeah. So in the interim, what sort of impact do you think the cumulative decrease in interest rates from September last year, that is 1.25 percentage points, what sort of impact is that going to have on the economy and more specifically on the consumer?
You know, we have to be honest. I'll start with the negative and maybe end off with the positive, because I feel like we're always pointing out all the issues. But we have to be honest that it's only really when interest rates or the policy stance is either neutral or accommodative that we can say, yes, the interest rates cuts that we've seen so far are supporting the consumer. We might see, better spending on that front. But really what we've seen, if you were working with a 4.5% target, is that interest rates have really just shifted to neutral. So they have less of a bearing on the economy and our spending. So you could, in other words, put it as the consumer is experiencing less restrictiveness or pressure from interest rates. So it's only really if we move below 7% with a 4.5% target for inflation that we would see the consumer starting to be supported. That said, the less pressure on the consumer is nevertheless welcome, right? So if the consumer has to pay less towards their bonds, less towards their cars, there's a little bit of money left over for people to start allocating to other things, whether it's paying down other debts or just spending, having that little bit of spending power given back to them. So you can expect the consumer to be doing a little bit better, but I can't say that monetary policy has necessarily being accommodative to the consumer.
Yeah, Koketso, very quickly, like you said earlier, the bank decided to focus more on what's happening in the local economy rather than on the global threats that are on the horizon, which are very real. But is this the last interest rate for us this year, the last interest rate cut for us this year, do you think?
We think so. And we've communicated this actively. In fact, since the start of the year, even since the start of the interest cutting cycle, we said that 7% is probably the neutral level that the MPC will aim towards. And I guess with a 4.5% target, that would have made sense. You leave it at 7%. You see how inflation performs. If it settles at 4.5%, then you are, performing well as a monetary policy committee. But with a lower target, I mean, what you're seeing now is that monetary policy will be more restrictive over the near term. So 7% is probably where it's going to stay until you see inflation expectations moving closer towards that new target that the MPC has pointed to.
All right, Koketso, thank you so much for your time and your analysis there. That was Koketso Mano. She's an economist at FNB.